All right. Hello, Gus founders and founder curious folk. Welcome to Fundraising Strategies for Early Stage Founders, leading your own round with SPVs. Super excited today to have with us Rob Lusk from Sidecar. Sidecar helps founders spin up founder-led SPVs, helps funds spin up funds, helps angel groups spin up capital consolidation vehicles, technology forward solution, really cool. And also Brian Hansel, founder of Holganics, who actually recently completed a round that incorporated a founder-led SPV. So super excited to bring some of that knowledge to you all today from both people who build the technology and people who used it. This event is part of the Grow series of the Gus Founder Curriculum. We're doing a whole bunch of events and an education around how to grow your team, product, and runway. So look out for additional events coming around this. This event will be recorded. We absolutely will send it out to you. I know everybody is going to ask the question anyway. I will continue to answer it. The follow-up will usually come in 2 to 3 days, and it will include some material about the rest of the curriculum as well. And I think that's it from me. Rob, take it away. Oh, one more thing. If you do have questions, feel free to plop them in the Q&A or the chat. If they are topical to what we're talking about at that moment, I will inject them in. Otherwise, we'll have about 15 minutes at the end for Q&A. And with that, I will actually turn it over to you, Rob and Brian. Thank you both for being here.
Yeah. Hey, thank you, Pete. It's good to be here. Hello, everyone. I can't see anyone, but I'm sure you're smiling and happy to be with us. Thanks for taking the time. I appreciate it during the day. I'm going to tee up some intros of myself and of Brian, and then we're going to get into it. Hopefully, I'm talking less and Brian's talking more. He's the one that just led a successful SPV raise. We can learn a little bit about Holganics and his experience. I'll plug in just with a little bit of the mechanics when it comes to operationally how to go about tackling this, and hopefully make it seem less burdensome as you're exploring running one yourself, and some of the considerations to factor into it. So in doing that, I am going to share my screen. We're not going to go too hard on the deck, but I will use it just a little bit here. So let's go there. Are you seeing the full screen setup? Cool. So let's jump into it. We're going to go over a few things here. High level fundraising setup. So maybe some of the considerations there. What is the whole story with an SPV? You know, bringing in multiple investors, capital consolidation. So why even consider doing that? And then what the purpose of the SPV has in that context. And then, you know, if you want to do it, how do you do it? So that's the high level agenda here. Real quick, won't talk too much about myself, but we work with a lot of founders and support this SPV journey. Had a good time with Brian over the last few months, running through their process. You know, for us, it's really the opportunity to be a part of that fundraising journey and a part of venture capital. We're an infrastructure player. Taxes, accounting are not super exciting things, but when it comes to being able to facilitate a raise, it can be pretty cool. And working with people like Brian and the Holganics team. So that's enough about me. Brian, and you'll be hearing from him soon, but he is currently the CRO at Holganics, and they are. I'll let him break it down, but this idea of a company that's doing well while doing good, there's a huge impact component to it. In the context of fundraising, they are now Series C, so later stage deal, and we'll kind of learn about the implications of where you are in your fundraising life cycle when it comes to SPVs, and again, talk a little bit about their recent experience. So let me kick it off. There's a couple use cases here, so just table setting here. The first one is what to do with smaller checks, what to do with like strategic relationships. Maybe they're strategic because they're your friend, or maybe they have some value add in the industry. How do you go about tackling that? You know, wanting to keep the cap table clean, wanting to reduce the administrative burden when it comes to fundraising, so you can focus on your business. The other one is more of a sort of circumstantial structure or situation. So the idea here is, you know, we think of pre-seed, seed, Series A, and run through the gamut of stages of fundraising. But what about thinking about injecting some capital in a strategic sort of circumstantial setup that maybe isn't so clear cut? We actually just did that sidecar. So you'll start to see things now, like, and maybe you already have seed plus, or adding some of these other sort of like stages within the stages, and maybe thinking about what an SPV can do for you there. So high level, what is it? Accessing capital, you know, bringing in more checks than maybe you otherwise would, and trying to tackle kind of the strategic value of it. What does the SPV do for that? So we're gonna dive into it here. Really high level, and then gonna turn it over to some questions with Brian. So an SPV, structurally, it's an LLC. Typically, the way we do it is we'll actually spin up a master LLC, and then we'll spin up a series LLC underneath it. It operates functionally the same way a typical LLC would. So it's actually a business entity, and that business is owning, its sole purpose of existing is to own equity in an underlying target company, right? So it's pooling capital to purchase an ownership interest in the underlying company. In this case, it would be your own, if you were on the founder side of things. And the idea here is that you can pool all of these individuals into that entity. You now have one manager, one line item on the cap table. And in the case of a founder, it enables you to actually retain some of the voting rights control, right? So it makes it easier for you when it comes to managing multiple investors through your cap table. The process, and this is what we want to dive into now. Brian, if you could jump in here, I think a couple questions that I'll just package up, if I could. Tell us a little bit about Holganics, your fundraising experience broadly, and then specifically how you came to the decision to spin up and run an SPV as part of your fundraising strategy.
You bet. Ian, thanks for having me. So Holganics is basically a probiotic for your soil. So we bring life back to soil. We do that in two different categories. We started in the turf, so residential turf, golf course, professional sports turf kind of industry. And then we transitioned into agriculture. So we're in broadacre row crops. And if you look at the early days of Holganics, which has been around for a little over 10 years, it was really focused again on that residential lawn and turf space. And that was fine. That allowed it to get from a startup to about 3 million in revenue. And it was a nice little business, but again, it wasn't scaling. There wasn't really the pull through that they'd originally hoped. As they transitioned into ag, it opened up a significantly bigger market. It took a few years to get credibility in that space and actually get some momentum. The last round that they had actually done was back in 2015. And again, it was all around the theme of turf and growing, in that space. So what we found ourselves in tail end of last year is a reality that we saw significant growth in the ag space. We saw a lot of interest from within that community to want to be, investors in the company itself. And we were looking at a growth curve that said, we were profitable last year, but to manage the growth, we wanted to put some additional cash on the balance sheet to know that we could get through this spring kind of, without any issues. And so our decision was, and I've said many times, and this has been my experience over the, long career, it feels like I've been in 8 different industries. I've raised a lot of rounds of capital. I've always said you cannot run a business and raise money at the same time, right? Those, you get so caught up in the fundraising part, you get so distracted that it's really difficult to also keep your eye on the ball from a company perspective. And our challenge was, this was time to have our eye on the ball, right? This was a monster growth opportunity this spring. We'd really gotten some good traction last spring in agriculture. We wanted to multiply the number of acres and customers we had this spring. So we really needed to focus on execution. But in the middle of that, we also didn't want to run out of cash just to manage our inventory and our growth. So we made the decision, and I think we talked to you first time, maybe tail end of the year, like December. We decided to bring this online in January. So the process itself with you guys was really days to pull the format together. And the reason we decided to do it is we wanted to be able to reach out to our community. So our round was 100% ag based. So everybody that came into this particular round was from the ag side of the business. It was a combination of strategic partners, which are people in the channel that were actually selling our product, and the farmers themselves. And again, across that gamut, it was a $2.5 million round. Our biggest check writer was $1 million. They kind of anchored the round as a strategic retail partner we had. But we went down to as little as 10,000, letting some farmers come in that really were hugely supportive, but again, weren't going to be as big a check writer. So I was looking at that reality and saying, I don't have the time nor the energy, honestly, to spin up a bank and try to get them up to speed and run a process and manage it. It was easier for me to talk to the end investors myself. I just didn't have the ability to manage the paperwork or any of the process. And so as we engaged with you and we started talking through, I'm like, this seems like really straightforward and something we can do. And it ended up being probably simpler than I expected, right? So the reality of our interaction is we had a reasonably straightforward investor deck. We embedded in that our financial model projections that we felt we needed. We had the one document that we had to spin up with the SPA between the actual SPV, the company that was built by Sidecar, that was going to be the investment document that they entered into with Organics. So we sold about 10% of the company in this round. And with that, it was a single document set that I had to worry about. The beauty of what we experienced with Sidecar is they take care of all of the paperwork between the LLC and the end investor. So all I basically had to do was populate those core set of investor documents into the platform. And then from within the platform, I just sent emails to people that were interested and gave them an allocation. So this is how much you're in for, log into the system. The system went ahead and took care of the accreditation to make sure they're accredited investor. It took care of all the paperwork in terms of them becoming a member of the LLC, the transfer of the funds itself. It consolidated those funds, and we had a single closing. So I don't know how far you want me to get into that, but from my side, what the net of it is, it enabled me to look sophisticated and professional in front of $1 million corporate partner who invested in us, but also made it accessible to the farmer who wanted to put $50,000 in. And to all of them, it was smooth. I never had to literally do anything. It was very straightforward in terms of how it happened. We did the round in about 10 days. So it was pretty quick from the time we actually launched it, kind of got through the paperwork. I think we had one investor who stumbled in terms of put in a wrong dollar amount because he keyed it in wrong. And we had to go back and fix, just that one entry and do it. But other than a typo, it was pretty flawless in terms of how, the end user was actually interacting with the platform. And again, we basically got the 2.5 close. I called up Rob and said, what do we do? He says, well, let us do this. And I get a call from my CEO saying, hey, the money's in the account. So I'll pause there, but that was kind of the experience that we had.
Thank you for that, Brian. Yeah, that's a great setup. I think the best way to understand this is just playing it out and breaking down the user experience and the story for you. A couple follow-up questions. How did you think about getting the soft commits, managing the investment process, and interfacing with leveraging Sidecar versus sort of the off-platform communication, when to invite the investor into the platform versus sort of getting them to a soft commit? How did you think through that and manage that?
Well, I think part of it was having a very clear message to them as to how the investment was going to come together. So having sidecar pre-engineered, so it was all teed up and I knew exactly what was going to happen, allowed me to have the offline, the direct conversation saying, hey, this is the investment, you know the company, let's talk through any questions you have, kind of what are you thinking about if you were to come in, how much? And as they would say, this, I want to put 250 in or whatever it was, it's like, well, this is how it's going to work. You're actually going to be, getting an invite, you're going to come through this process, and just the formality and my ability to explain how easy it was going to be for them. And honestly, how professional it felt from my side to explain it just made it feel crisp and clean. But clearly I only went to strategics that were excited about the business. So they were already sold on the business. They wanted to be a part of it. And then it was really just the soft conversation was how much. Like, do you want to come in for 50 grand? Do you want to come in for 250? And so you kind of set them up. For the most part, it was specific amounts. People would make it, but there's also the functionality. And I gave it for a few people to say, hey, I'm just going to go ahead and put you for, 1 to 150. I'll give you a range. And as you kind of think through it, you can just decide, and right in the system, you can just pick the amount. I'll just, allocate you a range versus a specific amount. So that functionality worked well, gave people the ability to kind of go offline and decide. They came back and said, I'm going to come in for X. But yeah, I had everybody, by the time I sent out an invite, they were already, emotionally saying they were in, but the ability to say, hey, I didn't have to see their anything. Like, I didn't have to see their information. They literally could just go into a third-party platform, extremely professional, and just go through it. Made it seamless for me. And I think it just added to, hey, this feels honestly pretty casual. You guys have your act together. You guys are on your front foot. You're raising this capital very quickly. I either get in or I get out. It just allowed for a sense of urgency and professionalism that kept everybody moving. And they never had, we just never stumbled around. And I think, time kills all deals. If you're not crisp like that, it definitely gives people the opportunity to pause and, well, do I want to? So we just didn't have any of that. There was no friction in the system, which I really felt was, a big part of what allowed this thing to kind of flow smoothly as it did.
Yeah, Rob, if you don't mind me jumping in, I've never really considered the fact that when you're raising from strategic partners, say in like the ag space or even directly from farmers, the UX of the raise matters so much more because these are often first-time startup investors.
Yeah.
Like, these folks haven't done this before. They don't have a lawyer on hand. They're not used to managing like the handshake protocol and figuring out and managing how to send wires. So even the process with people who do this all the time is rough, but making the UX of it so easy for first timers to come in, I think makes a huge difference. Not something that I thought about before.
And I will tell you, I think because it was so crisp, they didn't get lawyers, right? They're just like, well, this is right. Like, this is professional. It must be right. Because there was definitely over half the round came from people like that. I mean, as a farmer who would have just as soon wrote me a paper check, right? But it's like, that's not quite how we raise money. Like, you need to go through this process. But because it was, well packaged, I think they didn't question it, and they shouldn't have. But again, I think that professionalism just kept them from saying, wait a minute, I'm going to send this over to my attorney. I'll get back to you in 2 weeks, right? Because we didn't really allow them that much time. But at the same time, I don't think they felt the need for it either.
Yeah, and I think being able to keep up that momentum is so important, and having UX and tooling that keeps it professional allows you to do that in a way where you're not actually putting undue burden on the people who are trying to participate.
Right.
If you're moving fast, but you don't have a good system set up, then you're contributing a lot of stress into this situation. But if you have a great system set up, then it can be really smooth.
Well, and I think also it's an extension of your brand to a very real extent, right? Like, these people are seeing you, and I feel like we're a pretty small company, but I strive to swing above our weight in terms of our professionalism, kind of our polish, the way we show up in the world. And I really felt like this was an extension of that. It's like they went through this experience and like, yeah, that's what I would have expected from Organics. Like, that's how they operate. If it would have been clumsy and difficult, you can get people to pause and say, wait a minute, like, are these guys who I thought they were? So again, I felt like from the beginning of my interaction with Sidecar, I always had a pretty good feeling like, hey, this is a pretty well-run system. But my experience definitely, bared that out.
Did you have a solid closing date to create that? I mean, you're talking about that you're in, you're out creating that timing sensitivity. So did you establish that up front?
Yeah, we were very clear about that up front, and we had the luxury of being in a good place and having a lot of momentum, so we knew we could fill it around. That's not always the case. I know I've raised money, it was much harder, but the reality is that there's no question when we said, hey, this is the day of closing, we're going to send out your allocation. We gave them about 2 weeks from the time they got their invitation to close and fund. And I think, Rob, you and I, we were chasing around like 2 or 3 final wires, right? Just like, should we go ahead and close without it or not? And we ended up holding it together and getting it all done. But other than that, it was pretty flawless. But yeah, people had an urgency. It's like it was an end of the month kind of very, this is the cutoff date. If you don't make it in, that's fine. We're going to move on without you. And we had the luxury, if the round would have come up $500,000 short, it would have been fine. It was literally, for us. So I know we were in kind of a unique position compared to maybe a lot of people raising money, in that we weren't up against the wire. We weren't fighting for every last dollar. We needed the cushion, but whether it was 2 million or 2.5 wasn't super sensitive to us. So we kind of had the luxury of keeping our confidence about us and being very specific. But yeah, there's no question. We were definitive. Like if you miss this date, you missed the opportunity.
Yeah, I was going to follow up with how you got to the raise number that you got. It sounds like for you it was a bit flexible as far as where you ended up. But maybe a follow up to that then is, what about the terms? So how did you get to establish the terms of the round or of the SPV specifically? And yeah, how did that shake out in the context of the investors you were bringing in?
Yeah, I mean, we chose to be pretty generic in terms of the terms, and we were, I won't say favorable. I mean, the round was about 2x the prior round, but that really didn't matter because it was a quite earlier round. And it was very fair given where we are as a business and kind of the momentum we had. So I think we very fairly, and again, the soft conversations up front with people, I'm like, hey, this is what the competitive landscape looks like. This is how they're valuing their business. We're not doing that. Like, we are looking for people to come in that are strategic to us, and we're going to be fair with you. And so I think we fairly priced the round, to be honest. And I think that certainly helped. Nobody questioned our valuation at all. We didn't have to put together any valuation matrix or any comps or anything to really prove it. We just were pretty straightforward. And the terms were, again, very direct. There was, just 1-to-1 prefs. So it was pretty straightforward there in terms of, it is a preferred round, but there's no, there wasn't a lot of craziness. And I will say, even on some of the earlier rounds that Organics had raised, they had a fair amount additional complexity. And this, honestly, we just made it super straightforward, kind of very textbook. And for that reason, I don't think I didn't have a single person question the terms.
That's nice. Yeah, that makes it easier for sure. How are you managing like the communication initially with the investors? What was the package that you were serving up as far as diligence? Did you have a deck with any other material, and how are you running that side of it?
Yeah, I mean, I actually run 100% of it through the platform. So we didn't send directly out any information to anybody. We had verbal conversations. We explained the business to them. Obviously, they were already pretty close to us. But within the platform itself, there was an investor deck. So it kind of told our story, told the financial picture, and had that, and then had the SPA. So the document saying, hey, this is how the ownership structure between the entity you're investing in and Organics is going to shape up, and kind of define that relationship. So they had every right to go in and read the whole SPA. They had the right to see the investor deck. But that was really the depth of what we had in the system. And the rest was handled just more conversationally in terms of any offline conversations or questions they may have had. I just managed directly.
And Brian, were all of these investors prior relationships with the business? So did you already have strategic partnerships in place with the strategic investors that came in? Were you already selling to the farmers, or were there some people that you brought into this round that were kind of outside of your existing network?
Our anchor investor was a relatively new relationship that we had entered into a distribution channel with them. So we had struck that deal. but then they wanted to participate in the bigger picture because they felt like they could be meaningful enough in the growth of our company. They want to benefit on both sides, right? Getting an equity piece. And then quite honestly, some of the senior leadership from that entity also personally invested. And then the farmers, I would say half the farmers had committed to being first-time clients this spring, but had never used the product before, but just believed in the momentum of the space and where we were fitting. So it was a combination. I mean, a number of the people that invested, I had never met. I mean, I'd met them, but in a pretty casual way. Like, you know, you go into like with a farmer, typically I would go in and meet with them once, they'd commit, and then, you know, we kind of move on. So, but they, in those initial meetings, were excited enough about the company, you know, just made mention like, hey, if you guys are ever raising around, you know, let me know. And they absolutely followed through and made commitments. So it was a combination, but again, certainly we secured, you know, roughly half the round from, you know, both the company and the direct leadership of a channel partner that was already, you know, familiar with the business and backing us. So.
Awesome. Thanks.
All right. So I want to recap real quick here, the process. So getting that investor interest, validating the demand, establishing the terms, getting your docs together, and then spinning up the SPV, which you ran through the platform. So the process of actually just inputting the deal information and getting that live to then be able to bring your investors in. Will you speak just briefly to that experience, like the part of actually getting this thing set up and how that ran?
Yeah, I mean, you know, for you know, the interface is pretty straightforward, right? You just log into the system, you create a new deal, and then you just kind of start going through a step-by-step process, which is, you know, laid out for you. Again, it's you know, the heaviest lift is just having the documents to upload into the system to make sure that you're getting that clean and getting, you know, your banking information, some base stuff in. I honestly, you know, again, I'm reflecting on this, but I think if I had 3 hours total invested in doing it, is probably on the high side. Like that, there was very little actual work to get the program up and running. You guys had an approval process. You had to go offline, check the documents, everything's fine before you actually let it go live. But other than your diligence side, which you were doing, which I think took a day, maybe not even, my personal time in the system, again, was certainly, you know, hours, not days. It was not a big lift. And again, this is where we did execute this spring. We went 3x on our revenue from last spring, and we blew it out. And I was able to run the business and the sales team that entire time and not be distracted. So it definitely delivered on my hopes, because from the upfront setup through, again, the execution and even the close, my interaction was minutes at a time. It was not a distraction in my day. And I didn't really, that was what I was hoping would happen. Like when it was originally, Rob, you and I sat down and you described it, I'm like, well, if it's what you just said, that's perfect, but I don't expect that, because that's not how money races go. And basically, and I'll just put this on another little twist here, and I will say that makes us maybe a little unique. The CEO never saw the system and never talked to an investor. Like he never got distracted at all. He was able to completely stay focused and he called me when the money arrived. And he's like, hey, I didn't even talk to any of these investors. I didn't have to give a presentation. I didn't have to, be involved. And again, if we'd hired a banker, you'd have had to been involved in everything, because all they do is set up the meeting. You have to be in it to have every conversation and do everything.
Yeah, you've got to roadshow it.
How things played out here. And so that again, it allowed us to run a very successful, we did more in the month of April than we did last year, right? So we're in a very hectic kind of high volume, high growth curve. And this just kind of happened in the background and was not a distraction. The rest of the organization honestly didn't even know what happened. I personally did it. A little bit of interaction with our finance team. Our CEO, like I said, never even logged onto the system, and the deal closed. So that I think speaks highly of what you guys have put together for a UI. But ultimately, it is all these pieces, right? It is knowing that you've got some good anchor investors. It is the relationship you've built there to have their trust going in. But then to make it super easy, if they do trust you on how to make it flow, the system definitely supported that.
Yeah, I mean, I think it's an amazing accomplishment, especially in the climate that we are still navigating through. And I think it also, well, two things. We talk about traction a lot, right? Traction really matters. If the stuff is moving in the right direction, then you're going to have a much easier time. And if there's real revenue and real unit economics behind that, and a real, like, even this is kind of a second go-to-market iteration, but it's working. And if you can demonstrate that, it's going to be a lot easier to talk to people, especially now. But I think the other interesting thing about this is that raising from your community, raising from people who are already invested in the business in another way, doesn't end run around the typical roadshow and diligence process. These are people who have already done diligence on your organization in order to work with you. These are people who have an active business relationship. These are people who are fully invested in the solution to the problem and close to it. So, you're not pitching somebody who doesn't understand what you're doing. You're not pitching somebody you've never met before. And I think from cutting down on the roadshow aspect to making negotiation of terms easier, like all of that gets easier when you are working with people that you already have a relationship with that is beyond just an arm's length investment relationship.
And I can't tell you, I mean, on the flip side of this, if you look at, the anchor investor in this, I will say that they've been phenomenal, but they actually, as a sales channel this spring, did not perform up to expectation on either of our sides. Like their sales team didn't execute to the level that we had hoped they would, but they're doubling down now. They're coming back saying, how do we, get back to the team? We need to fix this because we are your partner, literally your partner. We invested. Like we aren't, because if they'd have had a flat spring and said, well, we tried, if they hadn't been invested, I don't know where we'd be at. But instead, we're having a strategic meeting to sit down and say, how do we get their team performing higher so they can be a bigger player in our world next year or in this fall product? But again, it definitely turning to your customers, as you put here, to be your advocates, it changes the relationship in a very positive way. They're looking for the good in you because they're now on your team. They're in it for the long haul because they've signed up for the long haul. So all those things I would highly recommend from a fundraising perspective is if you've got that access. And I got to tell you, I've sat on that fence a lot of times saying, yeah, but if I go to my customer and disclose my financials and I do this, is that something I really want to do? And I will say we're in a we're in a very high gross margin product. Like we make a lot of gross margin. So showing that to your customer sometimes is you can feel like, well, is that the right move?
Yep.
How much profit I'm making? But now they're on the side of saying that we want you to make profit. Like this is a win. Like this is good. So I previously have honestly said no to some of those approaches. And I just said, you know what, this is the moment because I'm not going to the capital markets for this raise. We can only do it from strategics and it feels right. And we were getting a lot of feedback that there was interest. And really that proved to be very, very true for us. And then on the other side, just the level of conversations or relationships, because they now are truly our partner, not just our customer, makes everything different.
Great call out. Circumstantially, the benefits of this, I just to recap that you're keeping your cap table clean. You're able to bring in smaller checks, whether that enables you to bring in customers or even just look at a different investor persona, right? That could be personal relationships. Really enables you to have other options outside of a traditional VC structure. And some of the benefits of that, the terms, getting to control that. You're the one dictating the terms of the SPV in the round, not someone else. There's all things I think to recap. So the last thing I'd like to do before maybe we open it up to Q&A is just quickly run through
Rob,
the process.
I want to mention this,
please.
Just to build on what you just said there. I got from the friends and family kind of people that you want to try to reward for having supported you personally or otherwise. We allowed some $10,000 checks to flow in at the end. never would have done that in a conventional raise. Like you can't be bothered. Your attorneys wouldn't, your bankers wouldn't have done it. And it feels hugely rewarding for the people that supported you, that said, hey, I just want to come along for a little bit. And it made it seamless. Like it literally was an email, like here's your allocation and it's done. And so it made it really seamless to allow for some of those smaller customers and good people around you that you say, hey, you're not writing a big check, you're not changing the world, but I do value you. And this was true for employees of some of our distributors who said, hey, I'm a sales guy out here 2 tiers down, but I'd like to put $5,000 in. And we're like, well, sure, why wouldn't we? Like, that's awesome. Like we're excited that you're excited. So this platform really did give us that. And we ended up doing that towards the end, which was kind of cool.
That's super cool. This is probably not a surprise, but Sidecar has done a number of SPVs for ourselves. And I mean, it's all the same story. Customers, ambassadors, people in the industry that we know, have a voice. All of those relationships or personal relationships, like I think to your point, Brian, of giving people that access to experience, sharing the upside of the setup. Not to mention the fact that that can amount to not an insignificant boost in capital to the company, particularly if maybe you're in a different situation than maybe you guys are, Brian, where you got to get a little scrappy in order to get the capital you need to keep going. And so it just opens that up. So that's a good follow up there. Quickly, just so you kind of know what this looks like, a bit of the mechanics. Brian spoke to it, right, as far as getting a deal page up. I think there's a lot of, the nature of the Gust Sidecar collab is that there's really a lot of opportunity to build out a stack for yourself and look at how you utilize different pieces of the software ecosystem to execute. And where those different pieces plug in, but you think about the investor network, your personal network, how you're then showcasing whether it's your raise or the company more broadly, and then how you execute, right? So there's the investor onboarding, the funding. We have the ability to even plug in with Plaid and just do an ACH transfer. So even funding is pretty seamless for investors on the product. People who think some people don't even know how to send a wire now, and you don't have to go that route. So I think that's a good place to stop here. I'm going to open it up and let you lead, Peter, on Q&A.
Yeah, we've got a couple of good ones. And just for the audience benefit, I'm going to focus on the SPV, Sidecar, and raise specifics, and then we can get to some of the broader questions that are in here. But before we do that, one question I do have, Brian, having raised in different capacities, could you dive into just a little bit more about the benefits of raising through an SPV in terms of investor communication and voting rights and kind of the administrative end of this?
Yeah, there's no question. To have a single entity come into your cap table, again, the Sidecar manages all the K1s, all the administrative side. So like on an annual basis, the company doesn't have any of that burden, right? So just really straightforward. Again, like I said, from taking in the money and now moving forward, you've got a single entry on our cap table instead of 20 new shareholders we're trying to manage and deal with K1s and all that administrative stuff. So again, the terms, the way we set it up, and the voting rights and all that just made it super clean and easy for us. And yeah, historically, I've raised a lot from high net worth individuals, and I love them all. But at the same time, when they are on your cap table, they feel like they have a direct ability to call the CEO and have a chat all the time. And that's great. But at the same time, there's something about what this has done is that it feels for, I think, the investors say, hey, this was strategic, but it's a little more passive, and that I invested in SPV, that SPV is actually the legal entity. I'm not, in the mix. So again, so far, knock on wood, it has been extremely positive. But yeah, if nothing else, just the pure administrative realities moving forward, it's just, it's effortless on our side.
Awesome. All right. Into audience questions. Two biggest ones we got. What is pricing? How does it compare to pricing for AngelList REVs? And can sidecar support companies that are domiciled outside the US?
I'll take those ones. I think probably the right ones for me. So pricing, we have it on a flex with a minimum and a maximum, meaning depending on where you end up in the deal size, you'll be somewhere in the range of either 2% of the deal size or a minimum of 4,500 or a maximum of 12,500. So another way of looking at it, any deal up to 225K will be simply 4,500. And then it'll scale up from there at 2% up to 625K deal size, where you'll hit the cap at 12,500. So Brian's deal was capped at the 12,500. The percentage that they paid was significantly less than that 2%, just given their deal size. But it enables even smaller deals where you ended up with 200K, 250K. I mean, we've done even deals as low as 50K, and gives you a little bit of that flex based on where you end up, because investors mostly are looking at it as a percentage of their commitment. What are they paying in fees to get that exposure? So we try to enable that. What does that compare to others? I think AngelList, I think you're at about 8K, and don't quote me on that, but I try to have a general competitive landscape sense. So in most cases for smaller deals, we're going to enable you to do it whereas otherwise you might, or where you might be paying double fees to or pass through to your investors. So that's kind of the differentiation in pricing specifically. To the second question, how does this is this supported with non-US? Yes. So we support international domiciled companies. We support international investors. And we have a really good process for that. Our banking rails are set up to make it really seamless for both the investors as well as for the receiving company, if it's yours, if you're not US based. The only sort of thing to add there is that all of these SPVs are Delaware LLCs. So the vehicle itself is going to be a Delaware structure regardless of where you're based. And we really advocate for that being the gold standard globally. There's a lot of benefits of using a Delaware LLC. It's been proven over decades of case law. There's a lot of trust that's been established in that structure. It's really cost effective. And so really, in most cases, that's actually a benefit to international investors. It doesn't really affect anything functionally as far as you running the process.
Awesome. Next up, comparison of a founder-led SPV versus a Reg CF round. When are you able to do a founder-led SPV, and when do you need to look to Reg CF? What are like the key differences and potential cost, cost structures to keep in mind?
Yeah, that's a good question. So when we talk about a founder-led SPV, or at least in the context of what we're talking about here, and this is a really good call out, we're talking about Reg D, Regulation D, as the exemption that we're using here for these structures, as opposed to the Regulation CF, Regulation Crowdfunding exemption. So those are two distinct paths to pursue when it comes to executing a raise like this, where you're pooling investors. So this founder-led SPV, Reg D, what does that mean? Number one, it means that these investors need to be accredited investors. So that's really a key distinction that you need to establish. Number one is, what is an accredited investor? Number two is, like, how do I run that process? And so I'll kind of break that down for a second. Accredited investor definitions by the SEC establish certain mostly financial. It can also be like an educational component, requirements that enable an investor to invest in a deal like this. So as an example, it's 1 million in assets that are not your home, or another would be your household income is 300K, or you as an individual have made 250K over the last couple of years. Happy to share the whole breakdown as a follow-up. We'll actually give you guys some resources that you can plug in across the board, and this is a good thing to jump into. I'll follow this by saying, you as the founder or as the deal lead, or even us as the platform, are not legally responsible for proving that out. And this is why. So within Regulation D, Reg D, there are two different underlying distinctions. There's 506B and 506C. Lots of numbers and acronyms, so that's just the way it
So
is
fun.
until we can brand it out with something different. But I'll just repeat it. So 506B and 506C. So in most cases, what we're doing is we're running 506B. So Reg D, 506B. What does that mean? Accredited investors only. 506B, they're self-certifying. So in the platform, like when Brian said, you invite someone to the platform, they create their profile. They're the ones that are actually checking the box. And we actually have it built out in a little flow where they can say, okay, this is why I'm looking at the options. This is why I'm qualified as an accredited investor. Now, two things to note on that. Number one is you should still check, ask them ahead of time. But again, that's on them. Why is it on them? Because 506B. So what does that mean? It means that you have a pre-existing relationship with this person, right? And so it's a little bit fuzzy as to how to define that, and that could probably merit a follow-up call with someone on the team, or again some material that'll go into a bit more detail on that. That's what we advocate for in most cases. The alternative would be 506C, which another sort of naming convention to add on to the acronym is general solicitation. So general solicitation means I can shop this deal, I can market it to people I don't know, which is now not a pre-existing relationship. Okay, what are the implications there? Number one is now this whole like self-certification of accreditation is no longer enough from a compliance standpoint. So now they don't get to just check the box in the platform. Now we actually have to verify their status as an accredited investor. So it adds a little bit of complexity and of administrative burden to, and maybe this is sort of a good segue back to the answer of the Reg CF, is you can even see within this current setup sort of like the stages. So if you would take maybe like the 506C general solicitation one step further to Reg CF, regulation crowdfunding, what does it do? Number one is it really opens it up as far as who you can market your deal to. Number two is who those investors are, like whether or not they're accredited. So within Reg CF, they don't even have to be accredited investors. So you can market to them. They don't have to be accredited. So in theory, it's appealing to certain founders, certain people raising because of the access to a broader target audience. The trade-off is the regulatory burden, the compliance factors, the cost associated with managing that and running that. There are other sort of layers of what the restrictive nature of it looks like as far as how much you can raise. I think I've probably spoken enough there. So what I'll do is send a follow-up that breaks down Reg D versus Reg CF. Again, these SPVs as such, whether you're calling it a roll-up vehicle or a founder-led SPV, in most cases, we're talking about these Reg D deals. right? So the first one, Reg CF would be the other, which would be publicly marketing. Don't need to be an accredited investor. Much higher regulatory administrative cost burden. And there are platforms that support Reg CF, some of whom we're partnered up with, like a Republic. So if you're looking at sort of kind of like making that comparison, happy to give you some material to look at and kind of look at like the cost benefit and the trade-off there.
Yeah, and a couple, I think, important things to clarify there. If you say you're doing a 506B raise and then you go out and you tell people you don't know about your raise, you are no longer doing a 506B raise. So it matters what you do, not what you say. Just a little bit under the covers in terms of what your like administrative and just information filing burden looks like. The process to set up, well, a Reg CF round generally has to go through a Reg CF platform. That's part of the regulation. Those platforms exist to collect a bunch of data about your business. So there's generally a larger initial information filing burden. The lead up time is generally a little bit bigger, but you do get access to a very different pool of investors. And generally the percentage you're going to be paying in terms of the amount of money you're raising is going to be a little bit higher than with a founder-led SPV.
That's a great follow-up to that, Peter. And I think it just brings to mind, none of this is legal advice, and you should refer to legal counsel when you're getting into some of the weeds on this. But yeah, Peter, you broke it down very well. Just be careful about what route you end up going with, and making sure that you're doing it the right way.
Awesome. Thank you. And a little bit about the voting rights. Somebody's asking for a little bit of clarification on how that works with a founder-led SPV.
Yeah, so one of the benefits, I think it was in one of the slides earlier, and Brian kind of alluded to this, just with like the investor relations piece of it, make more like qualitatively of making that more efficient and easier for the company, the operating company. But even legally and mechanically, there are some benefits as well. So the SPV, the manager of the SPV, in this context, you as the operator, actually has sole voting rights on behalf of the SPV. So for all intents and purposes, as far as making decisions on behalf of the vehicle, that manager gets to handle that. So it's one of the key benefits that we chalk up is this, which is you can bring in these investors, you can streamline the process. Not only are they more consolidated in their communication, right? Like one thing that's really nice is you can run investor communication through this structure, right? Whether it's updates, whether you wanted to do a Q&A, whatever you're doing, you can streamline all of that. But even from like a voting rights standpoint, you now get to pool all these investors into a vehicle that you control in that sense.
Awesome. Thanks, Rob. And I guess we can end it with a little bit more interesting and open-ended one, just around different instruments and structures for different rounds. We have a couple questions about using safes for early stage rounds, pros and cons, and then a couple questions about how to properly set a valuation cap if you're going to use a convertible instrument. I'll give them the Gus stock answer first, and then I'd love to get y'all's opinion. So first off, valuation cap, especially in the early days, is going to be more of a range than a direct valuation of your business. You do want to look at what you've got going on underneath in terms of financials, traction, usage, team strength, all of that. But really the number is going to be a negotiation between you and the investors. Looking at the valuation cap and how much money you're attempting to raise is going to give you an idea of the maximum percentage of your company that you are going to part with directly prior to the preferred round that converts that instrument. So for you as a founder, looking at the amount of money you need and the percentage of your company you are willing to give up to get that money in order to take advantage, hopefully, of a very large opportunity that you see. Because if there is no large opportunity to take advantage of, it is not worth selling a piece of your company. So that's the Gus stock answer. We'll follow up with some tools about that in the follow-up too. But Brian, curious to get your opinion on that and thought process, especially in the earlier stages.
Yeah, I mean, I've raised a pretty significant amount of capital over time in those early stages, again, in a debt structure. And again, it is emotion. Like investment is emotion. Like it's about your story. Clearly, you know, in my experience, if you're going to get early investors to take debt with a discount versus actually getting hard equity, you're going to have to be reasonably fair with that valuation. They obviously are having to buy into the much bigger opportunity and believing that whatever your cap is still very, very reasonable compared to what they expect the next round and the round after that to be. But yeah, I mean, it very much is a negotiation, and it's where you can look them in the eye and give them the story with confidence that that valuation is the low end of the spectrum and that you have every reason to believe it's going to be much higher than that. And the reason that you're not valuing it right now is because there isn't a great way to do that because you're early, you don't have revenue, all those things. And I haven't gotten a lot of pushback in my experience. If you hit that right place, you get investors saying, yeah, I can see why that's on the low end of the range, but yet it's still fair. And yeah, I certainly see how there's big upside here, but if I get that value, I'm getting a good investment, position. So again, I've done it a lot, and again, it is all about striking that balance to have your own confidence but yet still give them the sense that they're getting a good deal.
Yeah, I think we go back to this a lot just in terms of qualities that investors are going to look for in founders. And honestly, like the qualities that you should be looking for, vice versa. When you come out of a negotiation like this, everybody should walk away feeling not perfectly awesome about how it went. It is in your best interest as a founder to be honest, to push against the boundary of what is reasonable based on what you think this will be. And it's going to be the investor's job to come in and get the largest percentage of the company they can take without hamstringing the company's ability to succeed in the future. And you're going to find a happy medium. And if you find that, somebody's pushing too hard from one side or the other, it's not a good fit and it's probably not going to happen. It's a red flag somewhere.
Yep.
Rob, anything to add to that before we wrap up?
No, I think you guys said it well. One thing that I would just add is like there is a nice correlation with safes and some of the SPV use cases that we've talked about, right, with respect to maybe like raising between rounds and not being necessarily in that price round window where a safe can be really effective. So we see a lot of them in the context of these SPVs, and I think the approach was well stated by you guys.
Awesome. Well, I think we got through the majority of the questions. Again, we will send out a recording of this in a few days with some follow-up materials, both from us and from the folks at Sidecar. Brian and Rob, thank you both so much for taking the time to be here. Brian, especially hearing the stories from people who have actually and are actually going through it right now, super helpful to kind of fill in the gaps for everybody. Really appreciate you all being here. Audience, thanks for sticking around. And look out for some more events coming up in the Grow curriculum.
All right. Thanks,
one thing last thing that I would just add is if you want to get in touch, you see the link here. So we have a partnership with Gus. Again, we're really excited about what this looks like going forward. And you can probably imagine what the synergy is coming together. So go through that link, Sidecar. learn.sidecar.io/Gus so we can link you up, or just let us know that you found us through the Gus relationship, and we'll make sure to take care of you. Feel free to reach out to me directly, whether via social like LinkedIn or whatever. You can find me, or my email is rob@sidecar.io. I'll put it in well, I think you can remember it, rob@sidecar.io. So look forward to hearing from you all. And again, appreciate you guys joining us. It's, taking time out of the day. We hope to connect with you.
Yeah, absolutely. I just plopped that stuff in the chat and we'll include it in the follow-up as well. So thank you guys so much. Have an awesome day. Thanks everybody for being here. Thanks, and we'll see you again soon.
See ya.